Hi, today I want to tell you about a strategy called turtle soup. O1 is based on the market logic of how the big market makers, the big players, make money off inexperienced traders by simply taking all their stop losses. How often have you had a situation that you correctly predicted what seemed to be the direction of the chart? Do you realize that there will be a downtrend? For example, you open a position, set a stop loss, and the chart first works out your stop loss. Your position closes with a small loss, and then the chart goes really in the direction you predicted. And it's not an accident. In fact, the biggest trends often start exactly from the zones where the stop loss is triggered. And so it's very important for you to understand exactly where other players in the market are placing a stop loss. For novice traders, I will explain that a stop loss is a mark at which your trade will automatically close with a small minus. It's such an insurance policy for your deal. Let's say at this point, we think the chart will go down and open a trade down. And as a stop lock, we place here an order at a price slightly higher. And this stop lock will automatically close the deal with a small minus if the deal does not go according to our scenario. Here the price went down and we made money. But if we had predicted the market incorrectly, our insurance would have been triggered and the deal would have automatically closed with a small minus. This is called a stop loss. So many traders, when they see a clear resistance support level, they use that to place their stops. They set them a little lower than the previous values. And often, as soon as the price reaches not the resistance support zone, but exactly to the stop loss. After that, a strong movement starts. What does a turtle strategy look like? First, we need to find the consolidation period. A period when price is barely moving up and down, or when we have a clear flag on the chart. Next, we draw lines, support and resistance levels on the previous highs and lows. We put out support and resistance levels minimally. You see, up to this point, the chart was clearly moving between support and resistance, support and resistance, support and resistance. When the chart moves clearly and predictably in such periods, almost all traders draw these two lines, as you have on your screen, and try to trade from them, try to trade. Bounce right there. There's a bounce here, a bounce there, and so on. And stop losses on these deals are set a little lower. Well, that is, if suddenly at this very moment, the resistance support line will be broken. You have insurance for this case. And the turtle strategy tells us that when the price breaks the previous resistance support level after consolidation, the stop losses will automatically be closed. All stop losses that were above this zone. And as soon as all such buy trades will be closed automatically, then the price can go sharply in the opposite direction. For the turtle strategy, we first put a range on the consolidation by the highs and lows on such a consolidation zone. And after that, we wait for the price to go beyond its limits and bounce sharply downwards. In fact, here, even in this stretch of the turtle strategy, we may see it twice. First, it happened right here. Price went beyond support and then came back down sharply after that. This can be used as an entry signal, and we could even make a small amount of money here. But the main signal is right here. We can clearly see that the price first goes beyond the resistance zone, followed by a sharp red candle. What does this mean in terms of market logic? It means that the price has grown, reached the level of stop losses, which were set at this value. These stops triggered automatically, closing all trades that are against us. And after that, there was a sharp moment in the market, a sharp move in the opposite direction. Now that's a very clear setup on the turtle soup strategy for entering a trade down. We first have a breakdown of the main level, a sharp movement in the opposite direction, and this is where we enter a sell trade. That said, strategically, these will not necessarily be reversal moments, nor will we necessarily be looking specifically for a reversal. Often the turtle soup strategy helps you find points where the trend will continue, such as in this example. See, we had a clear and rising trend, and then after that price went into a consolidation, the trend just stopped and stalled as if. This is the consolidation level we need to set our levels. Let's put them on the chart. At the low, we put out a support level. At the maximum resistance level, so the resistance support levels are set, we wait for the price to go beyond it and return sharply. This is where we see that price has gone beyond the support level and we see a sharp pullback. Yes, it's not one candle, but there are 4 consecutive green candles here. We see a sharp upward momentum. And this strategy tells us that a sharp upward movement is about to begin, continuing the previous trend. You see, in this case, we are not looking for a bounce, but for a continuation of the trend. If we were to use this signal that the chart exit is a sharp pullback, and we see the chart move into a long-term rising trend after that, and we would make good use of this strategy. An important point, the turtle soup strategy, like in principle, any strategy of candlestick or chart analysis, it is better not to use it separately because patterns are sometimes false. Sometimes they form similar patterns, and this can give you sometimes wrong signals. Here are 2 rules of thumb that will help you improve your results with this strategy. First of all, if you have a trend, if you have a previous trend on your chart and you know that before that price was moving up, then try to look for upward signals only. That is, we would use this signal to trade up because we had a growing trend before. And if the pattern had formed around here or here, we would have missed it because it is quite dangerous to trade against the chart, against the trend. The second point is that the strategy is better used in conjunction with some technical analysis indicators that help to find bounces. This can be stochastic, RSI, and other standard oscillators, which help us to find pivot points through overbought and oversold levels. Here, for example, this is the point that I've talked about before. Here's the RSI confirmation on the pivot point. If we, for example, tried other indicators, they would also confirm our strategy signals. Let's look at the example of stochastics. Here also the stochastic confirms both lines of the stochastic are in the oversold zone. This tells us that the chart may be rising at this point. And the graph went up. Same here. When we found the turtle soup pattern right here, the chart went beyond the previous resistance level. Stochastic also confirms the downward signal. And we would use that signal pretty good profit and make a profit. So check signals through other tools that help you look for a bounce. And try not to trade against the previous trend. And in that case, this strategy will work very well.